Hello and welcome to this video in the series Simplicity in Stocks. I'm Sarit, Managing Editor at Equitymaster. Do you have the appetite to take high risk when investing in the stock market? If the answer is yes, then you can consider giving penny stocks a shot. Penny stocks are investor favorites because they can potentially provide huge gains in a short time. Investing in a well-chosen and fundamentally strong penny stocks have the potential to deliver profits greater than 1000% in 1 to 3 years. This is almost impossible in the case of any other category of stocks. This is also the main reason for their popularity. Investors are well aware of these potential gains and are constantly on the lookout for fundamentally strong penny stocks. So what are penny stocks? There is no fixed rule to define a penny stock in India, but a stock that trades below rupees 100 per share and has a market capitalization below 500 crore rupees is generally considered to be a penny stock. What about the risks? Penny stocks are, without a doubt, the riskiest type of stocks. They can crash anytime for any reason. They are infamous for wiping out 90% of an investor's wealth in a few weeks or few months. Even worse is their low liquidity in most cases. With only a limited number of shares traded on any given day, a slight increase in volume can move the stock in a big way. This is great if the stock moves up, but disastrous in case of a decline, as most investors will not be able to sell at a decent price. It is common to see a penny stock crash 50 to 90% when the market enters a downtrend. This is why investors should be extremely alert and cautious with penny stocks. Then there's the mistake of over-allocation. Retail investors think that they can make a fortune in penny stocks, so they invest most of their money into a few penny stocks. The result is usually a disaster. There is no shortage of stories in the stock market of people losing their life savings in penny stocks because of over-allocation. So how do you invest in these stocks the right way? What is the best strategy? First things first. Please note that this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Now before we discuss penny stock investing strategies, there are two things you must know about penny stocks. First is the big myth of penny stocks, and the second is the harsh reality of penny stocks. The big myth of penny stocks is that penny stocks are the best way to get rich fast. You have probably heard of this one. Even those who do not actively invest in the stock market may have heard this myth. In a bull market, more than a few penny stocks will do well. Some will most certainly become multi-baggers. This convinces retail investors that penny stock investing is the best way to get rich in the stock market. What they don't realize is that investing in penny stocks is perhaps the best way to destroy their portfolios. Why? The answer is found in the second point. The harsh reality of penny stocks is that most penny stocks in the market are toxic. There are many issues with penny stocks like sluggish revenue growth, low margins, losses, high debt, low promoter holding, high promoter pledging, etc. They are not considered prudent investments. If you invest in such toxic penny stocks, then you are risking the safety of your hard-earned money. Just think about it. Would you invest in a large cap stock if the company had a history of making losses? I'm sure you wouldn't. So you shouldn't invest in a bad penny stock either. Just because these stocks can go up a lot is not a good enough reason to invest. The risk-reward equation is not in your favor. If these stocks were to crash, your capital will be at risk. Even worse, unlike blue chip stocks, many penny stocks do not recover after they crash. So how do you find the best penny stocks in the market? The best penny stock investing strategy is to look for the top 1%. The only penny stocks worth your time and money are the best 1%. They are the only ones that will not crash 80 to 90% and most likely to rise 10x or more. All the stories that you have heard about penny stocks changing the lives of investors by making them rich are stories of the best 1% of penny stocks in the market. Most people don't realize this. They think one penny stock is like any other. So it doesn't really matter which one they buy. Nothing could be further than the reality of penny stocks. If you don't do your research and carefully filter penny stocks before taking a decision, you will most likely end up with the bottom 99% instead of the top 1%. This will result in big losses eventually. So how do you find the very best penny stocks? Well, it's a two-step process. First, filter the list of penny stocks down to the top 1%. Then second, select the best penny stocks from among the top 1%. Here's what you need to do. The steps to filter the penny stocks are as follows. First, debt. Avoid all penny stocks that have high debt. By high debt, we mean the debt to equity ratio should be less than 1. Ideally, this ratio should be less than 0.5. Promoter skin in the game. A company's owner should have significant stake. Reject all penny stocks in which the promoter has less than 50% stake. Also, the pledging of shares should be a strict no. Long-term business viability. Penny stocks can deliver great returns like even 50 and 100 times over the long term. But for that to happen, the business model should be viable. Look for companies that are likely to be around at least a decade from now. Profits. The company must be profitable today. If the company is making losses today, stay away. Now we come to the steps to find the best penny stocks in the market. After you have filtered down the penny stocks to the top 1%, you must shortlist the few that you want to potentially invest in. To do that, check these points. First is a strong balance sheet. Look for low debt, high cash balance and a current ratio greater than 1. That is, current assets should be greater than current liabilities. High promoter holding. The higher the better. It shows the promoter has skin in the game. Promoters buying shares from the market is also a good sign. Quality of the business. Ask these questions. Is it a good business? Are the fundamentals strong? Will it be around after a few years? Is it making profits? Cash flows. Find the answers to these questions. Does the business generate cash from its operations? If yes, then is it growing? How is the cash being used? Cheap valuations. It's a clever idea to buy penny stocks when they are cheap. Check if the stock is trading below its book value. A margin of safety of at least 20% below book value is a good entry point. Conclusion. In the stock market, penny stocks belong to the category of highest possible risk for the highest possible return. While they present potentially the biggest upside potential of any group of stocks, they can also erode wealth faster than any other group. This is the reality you must accept when investing in penny stocks. Here's a good rule of thumb for investing in penny stocks. Invest only what you can afford to lose. Investing in penny stocks is not rocket science, but it requires you to practice extreme caution. On the other hand, if done correctly, picking the right penny stock will significantly boost your portfolio's overall returns, especially in the long term. What do you think about this process? Let us know your thoughts in the comments. Thank you for watching.